In the last month or so, we've spoken to several clients who have just sold a property or are looking to sell a property and have come to us for some basic capital gains tax advice. Now, capital gains tax on property is very complicated because the calculation of the assessable part of the gain can vary greatly depending on the history and the use of that property over the period of ownership. In this video, I'd like to go through some very simple capital gains questions that we get asked and hopefully clear some things up for you. So one of the first things we get asked is, how much is capital gains tax? Is it 30%? Is it 40%? Is it more than that? Well, the truth is capital gains tax is not a separate tax in itself. How we work it out is we have to work out the assessable part of the gain, and as I mentioned before, that depends heavily on the use of the property over its ownership period. And then once we work out that assessable gain, we'll apply any sort of concessions and discounts that may apply, and then that assessable part of the gain is lumped on top of your other income, which you may have from salary and wages, investments, trust distributions and the like, and then you're taxed at your marginal rate. If the capital gains tax is made by a company or a super fund or another entity such as a trust, then different concessions may apply there. So again, it's not a simple question as to how much capital gains tax is. It will depend heavily on the circumstances and who is making that capital gain. Another question we often get asked is, when is a capital gains tax on the property payable? Well, capital gains tax on property is always based off the contract date, not the settlement date. Now, that can cause issues when you have the contract date falling in one financial year and the settlement date falling in the following or even a further financial year down the track. We have seen instances where the settlement is more than 12 months. So what you have in that instance is a taxpayer who has to report and pay the capital gains tax on a property sale before they even receive the settlement proceeds. The contract dates are also important when we are working out whether any discounts apply for holding the property for more than 12 months. Again, that is calculated off the contract date from when you purchased it to the contract date when you sell it. Settlement dates are not relevant whatsoever in that calculation, so just be mindful there. Getting those dates wrong may make a big difference to your final tax payable. So keep good records and best talk to your advisor before you sell, just to make sure that you get the right outcome. Another thing that we get asked is whether you pay capital gains tax on your own home. Now, that is not a simple question, or doesn't come with a simple answer, because that would again depend on the history and use of that property. If the property was ever rented, if it was ever left vacant, then all those sort of factors can make a difference on whether that property is going to be assessable. Have you run a business out of that property? Have you used it for any other reasons apart from just living in it? Those factors can also make a difference. So in the most simple sense, if you bought the property, moved in as soon as you can, lived in it for the life of the ownership, move out and sell it, there's a good chance it'll be capital gains tax free. But that's not always the case, so keep a very good record of the use of that property over the life of ownership, and talk to your tax advisor before you sell, and they'll be able to walk you through the likely outcomes. So there you have it, 3 simple questions. I hope that's cleared some things up for you. If you've got a fairly complicated situation where you've moved in and out of the property, own multiple properties, and you're looking to sell, then certainly talk to your tax advisor first. We're more than happy to help you out, walk you through the situation and the likely outcomes, give you a bit of peace of mind. Bye.